Welcome, welcome. Good morning.
Good
Hello,
morning.
Nick. Nice to
Hello.
see you.
Nice to see you.
Hello, hello. Hi, Michael, Carla, Maria,
Hello.
Alejandra, Ruben, Jorge. All right. Good to have you all back for another Monday morning. Welcome. So if you are new here, welcome. My name is Lindsay Lehr. I'm Managing Director of Payments and Commerce Market Intelligence. Welcome to our Monday morning coffee chats. We run these meetings twice per month in an open format as an opportunity to provide a space for open dialogue and mutual learning around the payments industry in Latin America. This is our fourth year running. I don't know what number coffee chat this is. That would be a good number for us to tally at some point. But we're very excited that you're here, and we have another great discussion planned for us today. So if we continue on, a couple of quick reminders to guarantee a successful session. We can go to the next slide. I think there might be a slight delay. Yes. Just remember, everyone, that this is an open format, right? It's not a typical webinar. It really depends on your active participation for its success. So we invite you. It's one of the few online events where you can really participate openly. So we invite you to raise your hand, put a comment in the chat. Go ahead and jump in if you have a question at any time. We'll be happy to engage with you. We want to hear both your questions and your comments. So please remember that we would love to have your participation. Okay. If we continue on. Got a bit of a slow connection today. Before we dive in, I just want to remind you guys we've been promoting this event for the past couple of weeks, and the week has arrived for the Crosstech Payments 2023 event here in Miami, put on by Crosstech. I'm going to be actually participating in two panels, both a panel and a workshop. I'm really excited for this event. It's the first time I'm attending Crosstech. It's the only event specifically geared around cross-border payments. So we're happy to offer a 15% discount to our network. If you haven't signed up already or haven't taken a look, I really encourage you to do so, and let me know if you have any questions, and let me know if you're going to be there. I know a lot of my network is already going to be there, so we'd love to be able to meet in person. Okay, let's continue on. Today, I am really excited to welcome back Ethan Clark from Backbase. I think, Ethan, this might be your third time joining us, maybe second, I can't remember. But Ethan is a fantastic friend of ours, a wonderful speaker, and we're really excited to hear about his vision. So thank you, Ethan, for joining us.
It's a pleasure. Thank you for having me.
Wonderful. And many of you also know Andreas Farage from the PCMI team, who helped put this content together, will be participating today as well.
Looking forward to it.
So what is the topic today? We're going to be discussing engagement banking in Latin America, which is a really fascinating topic. And the results of we're going to be presenting content to you today that comes from a study, our second annual study with Backbase, in which we do kind of an in-depth consumer surveys with users of digital banking, right? To understand its preferences, likes and dislikes, with the objective of educating banks, credit unions, and other financial institutions about the state of the digital banking consumer in Latin America. And I think, we did this for the first time in 2021, right? In the midst of the pandemic, when a lot of people started engaging with digital banking, either for the first time or more often. And in 2022, now the habit has been established. And it's really interesting to kind of see how preferences and behaviors changed just in a 1 year period. So we did this survey in 6 markets, most of the large markets in the region, not Brazil, which is, so really focusing on some other countries. We have data from Panama, from Costa Rica, which are not markets we always get detailed information on. So let's go ahead and dive in, and Ethan will share his insights with us throughout. Okay, so just to get us started, of course, to access digital banking, one must have access to the internet. And really, we're starting to really approach universal access to the internet. At the moment, this bar in the middle here. Oh, by the way, you guys can access the full report scanning this QR code, which is on every slide. So this is a detailed, full published white paper that you guys are welcome to download. These are just some highlights. So, this slide really just reminds us where we are in terms of internet penetration. We've come a long way over the past few years, right now between 80 and 90%. And in the next, by 2027, almost 50 million new users will join, and that will really take us almost to universal access. So we've really closed the gap. As many of you have seen our data, financial inclusion, digital account access is also pretty much right in line with internet access. Internet access is just a tad bit higher. So we really removed the access barrier to digital banking, which is an exciting fact. And this survey, what that means is that this survey, which surveyed people who use digital banking, is really accessing almost, more than 80% of Latin American adults in the markets that we studied.
That's a great point, Lindsay. I want to call out that, we're over 85, whereas last year we were about 75% financial account penetration. So really, really cool to see, and a lot more opportunity to grow.
And how they kind of track each other, right? So that's really interesting to see.
Yeah, there's an interesting when we talk about the demographics of this, there's an interesting thing to call out, which I think we often lose sight of, and that is this population of digital natives, right? They're the younger population that they were born and raised after a point when the internet was accessible. And outside of Asia, Latin America has the largest population of digital natives. And so this topic isn't going away because the demographic in Latin America is clearly younger, and the demand for digital resources is only going to continue to increase.
That's a great point, Ethan. And actually, in markets like Guatemala, which is a really fascinating market, I don't have the data right off the top of my head, but something like 50% of the population in Guatemala is under the age of 35. And so that's a market where digitization has been slower. But to your point, I mean, you're being born into the digital age. So we're going to see even, I think, more aggressive acceleration of some of these technologies.
Yeah, it's an ironic thing, because in markets like that where we see a low average age, but we see low adoption, the general assumption is the consumer doesn't want or doesn't know about those options. But the reality is, particularly with the younger population, they've been growing up with digital platforms, whether we like it or not, right? They're watching movies on Netflix and Amazon, and they're playing video games on an Xbox or platforms like that. And so from a very early age, they've already been taught about digital platforms, and they're coming to the market with an expectation that this is how things work. And it's amazing how quickly the adoption ramp takes off once there's actually access to those resources.
Absolutely. 100%.
Love that. Can I make an observation on this?
Please.
There's a UN initiative that's been going on for a while I think it's called the Last Billion, and it's to get the last billion people on the planet access to the internet. And when you're up at 90%, you've done it. Like, the vast majority of people that do not have internet access are because they're really not that interested. They might be 70 years old and just go, you know what, I'm fine.
Exactly.
We've done it. The next step is, again, what you were saying, and Lindsay, what you were saying is like having a financial inclusion is the next challenge. And it sounds like they're right behind. Like, we have done that. Like, the very first basic account, this is what we're all here talking about. It's like to have access to an account. Like, we've achieved that. Okay, so now what's next? Now you start expanding the services. But it's like, that is something to sit back and say, you know what, we've done a pretty damn good job so far. So just
huge progress, right? Huge progress. Yeah, absolutely. And it's nice to say, okay, first you remove the barriers to access, then you encourage people to adopt. Okay. Then you start to improve the quality and diversify the services, and then things just take off from there. And some of this report will get into those details a little bit. So now digital onboarding is a huge enabler of financial inclusion, right? Because if I'm in a rural environment, or if I just don't like going to a bank branch that's very formal and stuffy and maybe is in a different part of the city, I may not do it. But if I'm going to go open an account online, which happened massively during the pandemic, that's a huge removal of a barrier. And so here, we're starting to get into some survey results. We see the results of, have you ever opened a bank account online, an online bank account? And interesting to know is what we defined bank account as a traditional bank or a digital bank, or a neobank or a digital wallet. And so it's really nice to see the increase from year over year. And what I think is, look at this jump in Mexico. Mexico's been the laggard, right? Mexico's been the big economy that just has not digitized financial services and payments as fast as other markets. So it's encouraging to see this huge jump in Mexico. Okay. And then of those who have not yet done so, 9 out of 10 say that they're open to it or willing to do so in the future. So, it's becoming more commonplace and people are becoming more familiar. So here we have a lot of data, right? But we start over here looking at what other banking products have you opened online? And, credit, mortgage is the top one, which is quite fascinating. But credit are the next products that people go to after establishing your initial account, moving into credit. And I think this is interesting because, especially now that most accounts are free and P2P payments are free and access has been established, very much the hook for driving behavior is access to credit. So Ethan, I'm wondering if you have any comments there, just how financial institutions are reacting to this, if they're prepared to do a digital lending process online.
Yeah, it's a fair question, because as I have conversations with bankers throughout Latin America, everybody's having this conversation. Everybody's discussing this topic about how do they make this process easier, smoother, more intuitive for the end consumer. But I think there's something interesting to call out, because particularly as we have an audience of professionals like this that are in the space, I think we tend to use the vernacular or the vocabulary of the industry, and generally speaking, that's not how consumers operate, right? They don't walk around going, "I need a P2P payment," or that's just not what they say. And so when we talk about credit, credit is simply an extension of a consumer saying, "I need more flexibility in living my financial life." And institutions apply concepts like credit to that desire, but a consumer doesn't necessarily say, I need a loan." That's simply the product that we provide when a customer says that I need more financial flexibility. And so I think that disparity between what we say and what customers say, we have to be careful about, because it's going to play itself out as we look at some of these numbers deeper into the study.
Mm-hmm, mm-hmm. That's interesting, and I wonder, do consumers even say, I need more financial flexibility? Or, they may just be feeling a squeeze, right? Or they're feeling, some hardship, or, I'm having trouble making it to the end of the month, or, man, I'd really like to buy a car, but I just don't have the liquidity right now. Yeah. And how easy are banks able to detect that?
Yeah, it's great that you've already drunk the Kool-Aid, and that's precisely the issue. And that consumers don't say, I need a P2P payment. They need to say, I need to get more money to my son at college, or I'm having difficulty keeping up with my auto loan, or things like that. Those are the real world problems, and those are the words that are used. And then we internalize it and we apply our own technical or internal phrases to those things. And it often creates this disconnect between the two.
Mm-hmm, mm-hmm. Yeah, absolutely. The other thing I love about this slide here is talking about the ease of access, right? And how banks are increasingly enabling this digital experience. How long did the process of opening this online account take? So of those who said they'd open an account online, how long did it take? And actually, interestingly, Peru and Panama appear to have the best numbers. About 50 to 60% of people said that it could be done in under 10 minutes. Under 5 minutes, Peru and Panama had the highest ranking. And Peru and Panama also have very deep penetration of neobanks like Yape and Yapi in Panama, both offered by large traditional banks. Chile and Peru.
Yeah, of all the numbers, I take a certain sense of personal pride in the Peruvian number, only because I've been personally involved in a project in Peru that's aimed at driving financial inclusion to the informal economy, and it's aimed at this population of 24 million Peruvians. But Peru is not alone, right? Even in countries that have a very high internet penetration rate, like Chile and others, you do see this kind of groundswell. I think one of the things that we've discussed in the past is there's generally speaking been this myth when we talk about digital finance that there is a population of customers that will never migrate, right? They're too old, they're too comfortable, or they work in an informal economy and it's not a part of their ecosystem. And I think we've seen that play out in countries like Brazil and Chile and Peru and others, where those myths around subpopulations that would never adopt, that when they were provided access, adopted in very large numbers. I think BCI has a very good example of older consumers that they just thought that their adoption numbers, they just assumed from the very beginning that their adoption numbers would be really low. And when they provided digital access, they were shocked to see how large that number really was. And then it came back to what is the type of access. So for example, in that Chilean example, they learned fairly early on that an older consumer will adopt, but you might have to change the font and the appearance of the app to make it easier to use. But if you understand who they are and you adopt to what is unique about that customer, they will adopt in very high numbers. And so all of those myths, those populations that everybody said wouldn't adopt, I don't know of a single example where it's proven true. Every single subpopulation that we assumed wouldn't adopt, adopted in significantly large numbers.
Amazing. And Ethan, can you speak to, in some of these markets, you still have some population that's, is taking more than 20 minutes to open an account, or if anyone else wants to comment, what are financial institutions still not getting right in some cases?
Yeah, I would love to hear the perspective from other members of the group. I'll share with you what my experience. I think Mexico is a perfect example of this. And I have this conversation a lot. And oftentimes what I find is it's not the limitation or the willingness of the customer. It is, in fact, the attitude and the mindset of the financial institution that's providing the product. And I've had so many conversations with financial institutions in Mexico that when they think about this process of digital onboarding, they think about digital onboarding in the framework of, I can use this to improve my in-branch account opening process. And so I've been making the customer self-sufficient and allowing them to go through the process entirely on their own, from home, on their mobile device, however they want. There's still a limitation in the attitude or the mindset of the financial institution of, we simply want to improve upon our internal processes. And that's exactly opposite of what the customers are asking us to provide.
So I have a question that may be related to that. The numbers are there big differences between previously established banks and their speed as opposed to mobile wallets that are naturally going to be newer? They're already new, so they're going to be much faster to adopt things. So I'm wondering whether there's a big correlation there.
Yeah, that's a great question. I think what we've seen, particularly if we look at the difference in the report that we're discussing today versus the previous report, is there was an open question about whether consumers would even adopt third-party fintech. And there was this disparity between those that trusted their finances to a traditional bank versus those that would use a neobank or a third-party fintech. And that's basically been put to rest. Third-party fintech and neobanks are here to stay. One of the traditional advantages that they've had has been that they can move faster at the speed of the customer. And what I see across the region, from the Rio Grande to Patagonia, is the financial institutions are realizing that they're not just competing against other banks, but they're competing against third-party fintech. And this is starting to bubble up in terms of the developmental roadmaps that you see from one financial institution to the next, where that they know the tip of the iceberg is how easy do you make it for them to come in the front door, and they're moving rather quickly to kind of solve for that gap. So that delta still exists where you can move faster and the experience is easier and more intuitive with third-party fintech, but that gap is narrowing because financial institutions are moving fast to compete.
They're realizing the threat.
Exactly right.
And Ethan, do you think some of, what you mentioned about financial institutions wanting to complement their in-branch opening process, is it that they just haven't fully adopted the digital channel, or is there some benefit they see to the customer coming into their branch that they really want to maintain? Is there something there?
Yeah, great question. Because I think the level, first of all, let's take it from the point of view of relationship management. And that, yeah, we can certainly understand that you have high value, high wealth, high touch customers from a wealth management or corporate or business banking perspective, where you need to maintain that interaction. But it's really a spectrum, right? You have high touch customers, and then you have customers that should be self-sufficient, should be self-supporting. And oftentimes we apply a universal model across that entire population. Mm-hmm. And in some, I think that's the first thing is we try to treat all customers the same, when that's clearly not the case. The market tells us that. And the second thing is, and I don't mean this as an insult, I share it in the spirit of best practices and how do we improve, is sometimes an institution is simply locked on to their internal processes. It's an inside out view of the world versus an outside in view of the world. And as a result, whatever they apply from a digital perspective is looked at through that inside out view, and in often cases misses the mark in terms of what customers are expecting.
Mm-hmm.
So I have a side question that's related to this. The big banks here in the US, they really don't care about the individual account holder as much anymore. They're really focused on business accounts. They see that as that's where the money is. But they keep offering services to individuals, and they're on the high street because they always have been, and they've sort of been told they have to continue. But you have to go, if you really want services, you go to the credit unions and the smaller places. Is that the case across Latin America, or do the big banks still look for individual account holders and see that as the market they're going after? Yeah,
great question. It's a time, and not only is it a good question, but it's a timely question, because this is a question that financial institutions across Latin America are literally wrestling with right now, and they're trying to come to some solution for how they deal with it. If you look at the revenue per customer, retail customers are on the low end of the spectrum. And so you find financial institutions making decisions like, the options are, I'm a legacy bank with a legacy commercial banking endeavor, and I can completely rebuild that internally, or I can create a digital speedboat and just start everything from scratch in a digital only world, or I can partner with one of those digital customers and I can funnel those less profitable customers into that channel. And every bank is making an individualized decision about which one of those options they want to choose. But literally they're fighting this fight right now. I could probably name a dozen banks across Latin America that are in the process of this movement to make their retail customers more profitable by making it a digital only channel. And then the question is, how do they do that? We don't have the same options in Latin America that we do have in the United States. There isn't, outside of Brazil, there isn't really a groundswell of credit union alternatives across Latin America. That's really not a thing, again, outside of Brazil. But you do see this growth of third-party fintechs and neobanks that are bubbling up. And consumers have clearly indicated that they're okay with that option. And in some cases, they'll bank with both, right? They'll do all of their day-to-day money movement and they're living their financial lives through that third-party fintech. But they'll do the access to credit and the managing the wealth in the long term through their traditional bank. And so even customers are finding a balance between who gives me the best service, and they're willing to migrate literally at the drop of a hat to the one that gives them the best product. Hope that helps.
I really agree with that, Ethan. There's the behavior is, I do my daily money movement with the fintech just because it's easier, but I'm probably going to keep the bulk of my deposits. Probably my payroll comes into a traditional bank, and I keep probably the bulk of my savings in a solid financial institution that I trust, but I'm not going to necessarily use it for my day-to-day payments.
But now the challenge for us, again, back to we've got to be careful about being outside in versus inside out. That framework applies, but it applies to more middle-aged, older consumers, right? If you talk to a younger generation, most of their financial life is lived through that third-party fintech. And the moment they reach an event in life where they need a car loan or they get married and they're gonna buy a house, then the willingness to participate in a relationship with a traditional bank comes into play. But the model is actually reversed. They have a preference to go fintech until life circumstances deem that they have to go to a bank.
Right.
They'll go down that path.
Well, one of the realities, though, for the big banks, certainly but anywhere in the West, really, is that the internal business model is not really about providing financial services. The real drive internally is customer retention. And it was so obvious when I came over to this country because you had the big banks gobbling up all the small banks. When I first got here, there were 40,000 little banks and credit unions, and there are like 12,000 now because the big banks have been gobbling them all up. I was first at First Union, which was in Charlotte, North Carolina. It was when it existed. And the year and a half I was there, I think they took over 130 odd little banks. That was the way they grew. But they didn't buy them for the locations, they bought them for the customer base. And they knew they'd lose about a third, but so they bought them for the 2/3 that were going to stay. But the overriding model is we need to make sure we're not giving our customers a reason to leave. That's the driving force within the established banks. Most people don't like their bank, but they still trust them with their money. So we need to give them a reason not to go somewhere else, and then they'll stay with us forever. Mm-hmm. Well, from the sounds of it, the bank, I mean, that's a smart way to look at it, actually. I'm not criticizing it. It sounds like the bigger banks across Latin America are realizing that these upstarts are actually here to stay, and holy mackerel, we need to do something about this, so we're going to lose our customers.
Well, and with money movement becoming real time, and with PIX, with payment initiation in Colombia, with Spain, Costa Rica, now you can get your money out instantly. You don't have to wait 3 to 5 business days, and you don't have to confirm your account with a micro payment. This new technology and connectivity is making it just easy, to get. Sometimes it's just that smallest bit of friction that will prevent you from making a decision. But once that friction's moved, you can move your money out to a neobank or fintech account instantly, and you may not ever get it back.
That's exactly right. There was a moment in time when money movement was the wholly owned product of an established financial institution, and that's not the reality anymore. And although Brazil is excluded from the detail in the report, there is a good example inside of Brazil. You talked about PIX, which is kind of the government payment system, but there's a secondary app which preceded PIX, which is called PicPay. PicPay has something like 60 million active, or 45 million active accounts among a population of 65 million users. And those are people that live their lives, that are moving money between people to people, paying vendors, all of this stuff through a third-party fintech app. That's their life. And then and only then when they need something outside of that. So instead of relying on the financial institution for 80% of my financial life, it's now becoming quite the reverse. And to the point earlier, yeah, they are looking for ways to avoid offending their customers. But the day that a customer was married to their bank, those days are over. Mm-hmm. And the only option that a financial institution has today, and I like to say this fairly often, is they need to become jealous lovers because the marriage is over.
Ethan, there's a question in the chat from Jorge. I don't know if you have a perspective on it. How are the LATAM opening account times? How do they compare with US and other regions?
Yeah, that's a great question. So I've been specialized in this particular space in Latin America for 5 years now, and I'll tell you in that 5-year span, that number, the delta between the two has significantly closed. And although I would like to tell you that's a global influence because they're seeing what's going on in other parts of the world, but the reality is that's a reflection of that dynamic that we discussed earlier, that competitive delta between third-party fintechs and financial institutions, where we are seeing account opening in the single digits now, and as a fairly common standard.
Yeah, I think it's become a global phenomenon, right? You can just access banking online pretty universally.
Now, I will tell you that over the broader population, there's a much longer tail in Latin America, right? You do in the United States and in Europe and in some parts of Asia, you see a relatively tight population of financial institutions or experience providers where that average time to completion is relatively within the narrow band. And in Latin America, I will tell you, it's still a much wider population. You have a population of those that get it, that are moving fast, that are competing with third-party fintechs, and you have legacy banks that still want to drive people to the branch. And we're talking about, and this is still the case in certain institutions in Mexico, where that account opening can be days because they've got to bring back documents and they've got to provide this and they've got to do it in the branch. And there's still lots of room for improvement in Latin America.
Great. Well, let's move ahead. We have a lot more great content to cover here. All right. So, okay. One thing is, right, digital access, right? And but another thing is the experience. And that's where a lot of complaints tend to come from, right? But first, look, how often do you access your bank account online? Over 50%, almost 60% is, or even more than 60% is at least 3 times a week. So, I mean, that's pretty often. That establishes engagement. And then what I love to see in this data too is the improvement in consumers' experience. So top to box here means, right, the sum of the top 2 responses, which were very good and good, or excellent and good. And we see an improvement from 2021 to 2022 in every area, with security actually being the biggest leap. Now, probably the actual security probably did not increase that much. It's just maybe people's perspective and feeling secure, feeling more comfortable with it. Would you agree with that, Ethan?
Absolutely. In fact, if we look at this was actually one of the major concerns that kind of spelled the difference. I think where we see the movement is when we think about the last report, where we saw a disparity between traditional banks and third-party fintech was in the area of security, where there was a lot of institutional trust in legacy financial institutions. And the headline is third-party fintech has done a lot of work to actually close that gap. And so what was a competitive differentiator for traditional banks even a year ago today has rapidly changed. I mean, the market is literally, the rate at which customers are changing their expectations is, it's impressive how quickly thoughts are changing.
And I love, just to that point, and Andreas is showing us this data here, which consumers were asked to compare traditional versus new banking platforms and what they thought of security, ease of use, and convenient. And the winner in security continues to be traditional. However, easy to use continue to be new platforms, and the difference between the two is quite impressive. So traditional banks are still leading in security, but look at this huge difference between ease of use. Yeah, Nick.
I'm sure a part of that is that they've seen these banks for the last 30 years. They know they're still going to be around, and that matters. The security of the newer systems is because they're still here from 5 years ago. Oh, obviously they're doing it right. People are more comfortable because they're seeing it all the time. This is something that the conventional banks need to realize. They don't have this because they're better. They have this because they've been around longer, and that's disappearing.
Yeah, I can't remember the text, but there's the book that talks about this, and the concept is they're negative profits, and that is a bank has continued to make money off of these services because consumers did not have available to them, nor were they aware of that there was a competitive alternative. And the moment the competitive alternative becomes available, those negative profits evaporate because it was never predicated on good service. It was simply the limited options of the customer. And we're actually seeing that play out. I would challenge in one place where I would challenge the data, and we don't, Andreas, we don't have to go back to the slide, but we talked about it previously, and that was the frequency at which people are touching their app. Well, in our questioning, we used language like their financial institution or their bank. And the reality is applications like PicPay, consumers don't consider that their financial institution or their bank, but that's how they're living their financial life. And they're not touching it once or twice or 4 or 5 times a week. They're touching it 10 times a day. And sometimes because of the language, we're pointing them to a bank or a financial institution, but that's not how they're living their life. And I think we're just seeing the tip of the iceberg in terms of how dramatic that shift is.
That's a really good point, actually, because when you think about it here in the US, you talk about how long do you interact with your bank. You don't think about it when you use a credit card.
Exactly right.
But that actually does matter. And so that would be a third question, not just group them together. How often do you use this payment method?
Yeah, I think
really interesting.
Yeah, when you put money movement into a separate category and you talk about how they're doing that today, I'll predict it now. We're going to get back 12 months from now, and we're all going to say we were shocked at how big the delta was.
Mm-hmm. Amazing. Okay, great. And just to comment on this table really quick, these are kind of show some of the key improvements from one year to the next. And the biggest improvement was access to other banking products, kind of showing how banks are diversifying. They're doing a better job of adding their full suite of products into their digital experience. And Ethan, maybe that's an opportunity for you to talk about Backbase and what you guys do and how you help banks kind of facilitate that.
Yeah, thank you. What I have learned, what I've taken away from this journey in Latin America is, and it applies generally because I've worked all over the world, is generally speaking, banks tend to think about this as an in-branch or an online thing, where they think about it in the context of the duality of a back-end system or a front-end system. And what we've learned is that there really is an intermediate body of technology that has to help the bank manage its customer experience and move at the speed of the customer. Much like the operating system on your mobile phone allows you to use the hardware that's inside of the framework of that phone, a bank has to be able to use this operating system to move at a significantly higher rate of speed to match the tempo of the customer. And that's what Backbase does. We provide that intermediate body of engagement technology that allows a bank to move at the speed of the customer without disrupting or interfering with the underlying technology that's used to drive the bank.
Perfect. Okay, let's move ahead. Okay, and so here we start to see some brands, right? And these are very well-known brands. I'm sure most of you are familiar with them. And the question was specifically, who are the leading new financial platforms that consumers recognize and already use? And the numbers are pretty impressive. We see an increase in most areas here. Awareness is really impressive. I mean, going to this point of traditional banks over time losing that advantage of awareness and longevity. I mean, Mercado Pago's they've been around for well over 10 years now. And they've just continued to grow and continue to become more sophisticated and are very trusted. And you can see that their awareness levels are, really universal. Yape and Nequi also young. Well, Yape especially is much younger, but has just done a fantastic job at branding and awareness and ease of use and really, really impressive numbers here. Looking at Mexico, it's interesting. Mexico really has not had a champion neobank. You've had Mercado Pago there for a while. You have Nubank, who is recently starting to make some waves, but you haven't had a dominant player there like we have in other markets. But interesting to see Mercado Pago as the leader with awareness, pretty decent levels. Also, in same story in Chile, Mercado Pago Chile is not one of their strongest markets, but yet it is the leader locally.
Yeah, I do think it tells us something about to whom they are talking. I would say in Mexico, I do see more disruption, and internally, I'm aware that more competition is coming to the marketplace. I think we're going to see more digital-only options available in Mexico. We'll probably be talking about this more in next year's report, because I see a lot of these coming to market in the next 6 to 9 months. So I think that's going to shift. But traditionally, these payment platforms have spoken to a younger audience, and it is the population that's expanding and growing. As I mentioned, it's the second largest population of digital natives on the globe, and that's the heart and soul of their business, is talking to a younger population of users that are going straight from their Xbox to one of these payment apps, and certainly this has been my experience. Particularly what I'm seeing on the Brazil side with how PicPay and others operate with the Pix platform is a younger consumer, even when they're in their early teens, will actually reach adulthood with several years of experience of using this payments platform before they ever think about establishing a relationship with a traditional financial institution. The loyalty has already been well established with one of these providers before they ever reach the legal age of consent when they're going to open a bank account.
So kind of a methodology question here from Raul. How do you measure leadership? Is it by number of users or number of transactions? So on this particular slide, leader is defined by which brand was mentioned, is used the most by survey respondents, or had the highest share of use of survey respondents in this study. So, we have a list of, well-known, or, a list of 10 or so neobank digital platforms per country, and consumers would say whether or not they are aware of it or use it. And so we have the results here, and that's how we determine leaders just in this particular methodology. Great. And here's a question, Ethan. We kind of have a theory that in this liquidity crunch that we're currently facing, and venture capital drying up and everyone being under severe budget, really focusing on profitability, do you think that this panorama will change? Will banks take more of a protagonistic role than they already do? Do you expect concentration to take place among fintechs? What's your opinion on that?
Yeah, great question. In some ways, I think the pandemic has affected a pretty significant sea change in terms of the attitudes and mindsets of bankers, not just in Latin America, but around the world. If we had reached this point, we talk about this liquidity crunch. If we had arrived at this particular point in time without the pandemic, then my answer is, yeah, we probably see some slowdown in investment in terms of how banks are thinking about their developmental future. But the pandemic has really opened the eyes of bankers, and they realize that the more profitable path and the more effective path is to do more digital, because they found themselves in a circumstance when that was the only way that they could interact with their customer for a couple of years. And they're finding that the adoption rate and the usage has now exceeded profitability of some of their traditional lines. And so I would say today, no, my gut says you're going to have financial institutions replace legacy processes with more digital alternatives, because they've now seen the profitability and the ease of management of those systems.
Makes sense.
I'm finding something
Great.
fascinating on this. Sorry for jumping in. It's like the right side of
Please
that.
do.
Like pay utility bill is number one. 2, 3, 4, and 5 are all splitting something. That's fascinating to me. It's like that's an important ability to be able to do if you want to be providing these services. I didn't realize that.
And there's something hidden in that comment. And it tells you something about who these people are and who they're using. Because if you do money movement through a traditional financial institution, you're usually not provided an alternative to split a bill. But if you work through a third-party payments product, generally speaking, that's table stakes for one of these products. And so the fact that they rate so highly actually tells us something about where these people are living their financial lives, which is why I issued the challenge to the data earlier about how often they're touching their apps, because I think we're actually missing a groundswell of movement that's simply excluded based on the language that we use.
Mm-hmm. And I like how split other bill, split bill at an event, living expenses. These are just, different names for a P2P payment, right? These are just different use cases for a P2P payment. And how those would typically be paid in cash, right? If you're going to pay your rents, or you're going to, pool funds to pay the utilities for the month, or get a gift for someone, those are cash payments. And so here you're not really competing with cards. You may be competing with bank transfers, maybe, but mostly competing with cash. And so it just speaks to this cash displacement we've seen over the past couple of years.
Well, think about where this functionality was born. And again, I'm going to come at it using the language of the customer, right? So where did this functionality to split a bill come from? It came from ride sharing apps, because I'm in a car with a friend, and I shouldn't pay for the ride for my friend to get from, my place to his place. He's got to cover that. And so this ability to subdivide value in the minds of the customer, again, it's fairly common with my friends in Latin America, where their kids have been using Uber, from the time that they were 12 years old. And all of their expectations around the functionality that should be there has been established by somebody else that isn't even isn't even a financial institution, but it's affecting how these apps market themselves to these consumers. Mm-hmm. And the headline is, it's not going away, right? It's not going to change. It's just going to move. The change is actually going to move faster.
Well, and the interesting thing is that once you've built the capability of that into a system, it's then available for everything. Like, you put it in there for ride sharing, and now it's in there for paying the utility bill. Now it's in there when you go to a concert. Now it's in there when you're buying anything. You've built the capability into the system.
That's precisely right. And as customers become more aware of this, their expectations to use similar functionality in other parts of their life continues to expand. So what's actually driving this is the customer expectation. And the thought and the belief is, it's no longer about a list of fixed features or functions that a financial institution has to provide. It's how quickly how in tune are they with the evolving needs of their customers, and how quickly can they respond to actually provide those services that customers are asking for.
So I have a question on this. When you are splitting a bill, do you have the two people pay their half directly? Or do you have one person send money to the other, and that person then pays for all of it?
Yeah, that's a great question. You're gonna see a wide variety of application in terms of how they address it. But the most common way is, you have to have a platform that's willing to split the difference. So it's not actually a payment between the two. It's that the platform itself is willing to take a $100 bill and split it 50-50 and create two bills, one that goes to each party, or three, depending on the population, right? And so it actually requires a third-party facilitator that's willing to actually do the math and do the work. And that's where the platform comes into play. So I'm not actually, if I'm sitting in an Uber car with my best friend and we need to split the bill, I'm not sending him money. He's not sending me money. I'm simply paying half of the ride to Uber, and Uber is charging the balance to the other rider in the car. And so the platform becomes an essential third party here to make that work.
Mm-hmm. And a question from Sergey, do we distinguish online banking and banking mobile apps? I believe in the study, we defined, folks are asked to respond to their use of digital banking, which is via mobile app or online banking. And, you're right, based on the responses, we do have a question in the report, how often to use mobile versus online, but in this aggregated data, it's heavily influenced by mobile banking. Okay, let's move ahead. Okay. All right. So additional services, I find this to be really interesting, right? Banks have already done a great job about diversifying their services online, but there's still a long way to go. So the first response is fascinating, right? Free transfers. When free transfers are already available in most markets by select institutions, whether it's a neobank or digital wallet, and then many banks offer this, and it depends on to whom you're sending, but 40% of respondents are still have unsatisfied demand for free money movement. So, that's infrastructure that's being built, but, can still be inefficient in a lot of countries. Right. And then beyond that, we have more sophisticated things, investing, which is number 2, which is quite interesting. Budget analysis, loans, and the list goes on from there. But still, we have some basic needs that are still not solved for. And it's interesting to see this at a country level, and the report goes into more detail there. I also love this question. Yeah, was there a comment?
Yeah, one comment over there, Lindsay. Gerardo here.
Jerry.
This transfer was about internal transfer or cross-border transfer, because it's a different issues.
Yes, it didn't. The question, we did not specify cross-border or domestic.
Could be interesting.
In this particular question.
Because maybe the people, it has a free access, like Pixis is a free internally, like Mexico, Panama, a different solution. But maybe they talk about international transfers, they're going to be the different. Just pop out for an idea. Could be the.
Yeah, could be, absolutely.
Yeah, I do think this, back to what we were discussing before, I think who we're talking about and what we're seeing in the data, for example, when we're talking about bill splits, I think is probably moving the needle here too, because one of the advantages that a person living their financial life, if their primary application is one of these third-party fintech products, then the muscle from a technology perspective to move money around is actually a bit of a limitation. This is something that they're often talking about. Open banking is kind of shifting that thinking, but open banking today across Latin America does not reach down into third-party fintech. And so that is kind of a bit of a weakness. I think is a bit of Achilles heel where traditional banks still have an advantage. In that, back to what you were saying, Lindsay, if we're thinking about traditional financial institutions, and free transfers are usually table stakes. You get into third-party fintech, and that's where you actually start to run into some of these issues. So I'm not surprised that population that talks about splitting bills as being important is also running into a limitation, because splitting bills is a strength in the application that they use, but transferring money around inside one of those apps is a limitation. So I think those things actually complement one another.
Interesting. I like that investing is number 2 as well. It's very, there aren't that many easy opportunities for investments in Latin America. It's getting built out, it's getting improved upon, but that seems, investing in credit are kind of the next evolution of easy digital finances.
Yeah, I do think so. Remember last year we were talking about whether or not they would even use digital, and we were seeing the
right
numbers. And this goes back to what I was saying about how quickly consumer expectations are shifting. Because 12 months ago, we were talking about, would these consumers even use a digital channel? And now that question's been put to rest. And they're already reviewing across their financial lives a long list of things that they want to go do that last year they weren't even thinking about. And that's so what is compelling to me is what's going to be on this list next year that we didn't even see coming because of how quickly customers.
Absolutely. And then great question from Paula. Do you think investment increased because of inflation, or what do you think the cause could be? Any idea on that, Ethan?
Oh, sorry, I thought that was a question for you. So, yeah, I don't think we have enough information in the data yet. I have a couple theories just based on my interactions across the region, and that is, you touched upon this earlier, in that Latin America does I would say it's probably 2 to 3 years behind what I see in other markets, or globally speaking, in terms of the availability of what I would call user-driven finance. So, for example, in the United States, we have applications like Acorn that allow non-traditional investors to find ways to plan for their financial future. And those types of applications are now just starting to peak, pop their heads up in Latin America. I would be interested in seeing how we fine tune this number as we get into next year's report, based on the number of these apps that are coming to market.
Terrific. All right, and let's move ahead. I think we have just one more slide here, so we're good timing. I think the whole driving point of the report is to emphasize the fact that consumer preferences are changing rapidly, and that financial institutions need to be prepared for this and need to have a fast time to market, right, when rolling out new features. So, and to this comment from Banco de Bogotá, it sums it up very nicely, right? And to your point, even speaking about kids growing up with video games with a seamless, highly agile digital experience, that's the benchmark, right? So do you want to close out with any final thoughts on that?
I mean, this is really the big overarching theme that I'm seeing, that and is finding its way into every conversation and every financial institution I have throughout Latin America. Banks, because the evolution of the banking experience moved so slowly, banks for a lot, particularly the larger banks, thought that they had, hey, when a new feature or a new demand comes to market, I've got 2 or 3 years to figure this out. And I can move at my pace, at my internal pace, to get this product to market. And they were all thinking about this from a product perspective, and the product was was a checklist of things that they had to have. And that's pre-pandemic thinking. And any bank that sticks to that thinking, just as we see in the United States, is going to fail, because you have to be moving at the speed of customers. And what we've seen, one report over to the next, is customers' expectations are moving so quickly. So last year, if we were having a conversation as a result of last year's report about customers wanting to do financial planning or investments, we would be sitting here today still talking about banks that don't have that product in the marketplace because they can't run fast enough. So the reality is, if a traditional financial institution is going to maintain viability into the future, they're going to compete with third-party fintechs and a solution that's being built in somebody's garage right now that we don't know about, right? Back to Bill Gates.
Yeah, just, a couple of coffee chats ago, we had a fintech here that was enabling Brazilians to invest in the US stock market, right? And facilitating those cross-border money movements, right? I mean, you can dive into that, invest. Maybe the next evolution will be, okay, how do you want to invest? Is it crypto? Is it stablecoin? Is it US stock market? Is it local stock market?
That's right.
Drilling down into those points.
If financial institutions are waiting to see some analysis like we provide here to say, hey, I need to be thinking about this, they've already lost that match. It's already over. They don't even, they're dead and they don't even know it yet. Literally.
So there's an interesting caveat to that, because what you said before about the general things, like you can continue to, like, if you ignore the competition, the moment someone else offers something you don't, people are going to switch. Slightly different here, because people bank based on where they feel comfortable that their money is safe. If you start and okay, people still do all their banking at the bank, but then they start using this service over here because that's available. After a while, if my bank doesn't offer the same, I'll give them a bit of time. But if they don't offer the same after a while, I'm going to move the bulk of my transactions over there and only use you occasionally. That's if they can keep on saying, we're going to be offering this soon, then people will stay. So they have a little bit of a window, but not much.
You're precisely right. Back to the comment about they need to become jealous lovers. I think Lindsay probably has more experience with this than I do. But what you see in terms, if we look at just the population of third-party fintech and these applications that are available, when they came to market, they were generally only basic money movement accounts. Whether we're talking about a wallet or a new bank or what have you, they were all based on kind of the account management side. And in every single circumstance, I see this movement towards access to credit. Well, why are they moving to access to credit? Is it because they know something that we don't? No, it's because their customers are asking them for this particular feature. And the first person they want to talk to is their neobank, not their traditional bank. And so the idea that a bank sits back and says, I feel comfortable because these are services that are only reserved for me. If they have a level of comfort and their business plan is predicated on kind of the protective nature of sticking with these services, then these products are going to bypass them because increasingly they're moving into these markets.
Fantastic. So we do have to wrap up. But before we sign off, I just want to invite you all to, if we can move to the next slide.